I want to show you my medals here. Okay.
Yeah, good for you. I just started to play, so I built a pickleball court in my driveway.
Oh no, really?
It's a great way to play with my grandkids.
Yeah, okay, you guys.
Got my own court and everything.
All right, good deal.
Oh, hilarious. I think we're live. I think this thing is working. Hey, Choose FI, if you are out there and you are seeing this broadcast, please, 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 would you please make a comment? Oh, there you are. Okay, I do see you all. Okay, so please accept my apologies. There was a small technical delay. Facebook has done some really funky things that has changed up the whole broadcast issue, and I am actually hoping that we didn't lose any of you. So if you're watching this and you can share it with other people that are pending or looking for the broadcast, I would greatly appreciate it. Thank you so much for your time and energy. Okay, so my name is Jennifer Ma. I'm your Choose FI Community Manager. Welcome, welcome, welcome. Thanks for hanging out with us tonight. I am super excited to introduce you all to this stellar group of people, all pickleball fans. I had to learn what pickleball was today. So we have Rick Ferri.
Pickleball star.
Oh, look at that. He just showed us all of his medals earlier. We have Larry Swedroe, also a pickleball and a player as well. I don't think I want to meet them on court. And then Paul Merriman's claim to fame, he invented the game.
No. It was invented right here on Bainbridge Island.
Oh, I know, but I just can't resist teasing you because all good things are here. Look at me.
Easy.
Yes, I'm just going to give you a hard time. So if you are watching, please let us know where you're from. And if you can, please share this live feed link to the entire Choose FI community, because Facebook changes have just made this incredibly painful. So thank you. We've got Brian in the house. We've got people from Canada. Hey, Minnie. We've got Daniel. Let us know where you're from and hanging out. I totally appreciate you being here. We've got Peter Gallant. Hey, Peter, good to see you. And Jennifer Adams is here. And yes, Marzina acknowledged. Thank you so much for letting me know. And we've got Bill in the house. There's some really great familiar names. Thank you so much. And look we've got Covington, Virginia in the house representing. And look at this. Bill says, hello, Rick and Paul, but just you and me, Larry. I don't know about that. He's off my brownie list. That's it. No more brownies. And then, Peter says, there's so many comments. It's just crazy. They're just flooding it right now. So Peter says there's well over a century of investing experience on this video. No, we're all really young. And then Houston, Texas is represented. And then VP DePape Town, Salt Lake City's in the house. Thanks for joining us instead. Just so that you know, if you have to cut out in order to attend the debate, we understand. This is still going to be replayable. All right. And I'll be posting that link as well. Nashville's here. NYC is here. That is so fantastic. Okay. So while you guys are catching everyone up where you're from, I want to actually ask all of you all to introduce yourself, because while I'm a total fan, and not that I socially stalk you on Facebook or the interwebs. Don't tell them, guys. Please, would you please introduce yourself, Rick? I know that you were a guest on episode, the Staying the Course episode with a killer cake analogy. Was that 170, 180? Anyway.
I don't know. I'm sorry.
Oh, it's okay. I will go ahead and share that link in the feed. This is Rick's episode with Choose FI. He came on board. He did 2 coats. He actually escaped from Wall Street. So, Rick, can you tell the audience who you are a little bit and your passions and interest in?
Sure. I'll just take 2 minutes. So my name's Rick Ferri, and thank you for having me tonight. I'm really happy to be here. And I'm glad that to be here with Paul and Larry. It's a real pleasure to be back with these 2 fine folks who we've known each other for many, many years. So this should be quite interesting. And I've been in the investment business for 32 years as an investment advisor the whole time. I was 10 years with a brokerage firm, almost 20 years running my own asset management company. And then for the last year and a half, I have been just an advisor doing hourly advice, but not managing money anymore. So that's me. And again, happy to be here.
And Rick is really selling himself short. When he said just, I almost cringed. Did you see my face? He is not just anything. He is a retired USMC Marine Corps officer and fighter pilot. He is a professor. He's written books, and he is now president of the John C. Bogle Center for Financial Literacy, which is also a 501c3 organization. And he hosts the Bogleheads investing podcast. And I think I just butchered the name of the podcast. My apologies.
Thank you. It's Bogleheads on Investing, and we have some great guests. So if you look up Bogleheads on Investing, you'll find. In fact, both Larry and Paul have been my guests. So we've got some really very interesting people on that podcast. But thank you for mentioning it.
No, it's awesome. I mean, I believe in that mission. And John Bogle, he is a hero in my book. And I think a lot of people in the FI and personal finance space would concur. So, Larry, I have to admit, I danced a jig when I heard you had agreed to come on. So not to embarrass myself, but for the fans that don't know who you are yet, can you go ahead and introduce yourself? What's your claim to fame?
Well, I don't know if I have any claim to fame. I'm the little baby in this group in terms of investment management or advisory. I've only been doing that for 25 years, unlike Rick and Paul, who got me. I spent the first half of my career, the other basically 25 years, advising some of the largest multinational corporations in the world on managing all kinds of financial risk, interest rate risk, foreign exchange risk, etc. I ran trading rooms for two of the largest financial institutions in the world, foreign exchange, interest rates, mortgage banks. I was vice chairman of the largest mortgage company in the country, including managing all the credit, liquidity, interest rate risks, before I joined Buckingham 25 years ago as the chief research officer. Unfortunately, I'm not a professor like my friend Rick, but I have guest lectured at many universities. My books, I've written 18. A bunch of them are used at universities around the country as textbooks. And now I'm the chief research officer for Buckingham Wealth Partners. We have our RIA manages about 19 billion of assets. With over 40 cities, locations around the country. And we're advisors to literally hundreds and hundreds of other RIAs around the country, advising them on investment strategies, business practice, and all kinds of financial planning issues. And collectively, they manage another 32 billion. So it's about 51 billion of assets under management. And I'm currently working on 3 more books, so we'll get that up to 21.
Which is a really lucky number. It's one of my favorites. And you can actually find a little bit more out in terms of his writings at seekingalpha.com. Incredibly, very accessible writing. And that's coming from a layman who's, I'm really very much self-taught. And I feel like I can actually get the gist and follow along.
Thanks, Jennifer. I write for 4 websites now. If you're a real geek and into the investment, technology, those articles for people like Rick and myself are posted at Alpha Architect. There's a website called Advisor Perspectives. I write for them. Also more technical, but not quite as technical. And then I write for Evidence-Based Investor, which is really more retail average investor Joe, and then also for Seeking Alpha. And right now I'm running a series of articles for both Seeking Alpha and Evidence-Based Investing that tell stories that you were referring to, including my personal favorite, The Big Rocks, and the follow-up, The Big Rocks Portfolio, to teach people the winning strategy in life is passive investing, not just in investing. Yes,
absolutely. And so I also noticed that on your Twitter handle, you write that your opinions are your own, not to be representative of Buckingham. So
that's
I just want
a compliance issue, of course.
Well, and I've got my own compliance issue too. So, and of course, You guys, Paul Merriman's back in the house too. I don't know if you remember last time he was here with a couple of other foundation members, Daryl Balls and Chris Pedersen, and we had a 2.5-hour discussion on investing. I'm not guaranteeing 2.5 hours this time because it's at the graciousness of our guest speakers. But Paul, do you want me to introduce you, or would you like to introduce yourself?
Well, no, you go. No, I'll do it because I want to start by saying that I have a list of 10 truth tellers, and 2 of them are sitting right here tonight. And so I am honored to be here. I don't manage money. I teach. I did manage money until about 2012. And then I retired and sold my firm. And as a matter of fact, the firm that we sold to, Larry had been trying to convince me to do that years earlier. And but it finally happened. And I got to start a foundation, a financial education foundation, writing books, articles, working at Market Watch. When I say working, without pay, because when I started the foundation, my promise to my wife was I would never work for money again. And she thought I said I would never work again. But I'm loving it, working just as hard as ever. And my mission is to help not just young people, but a lot of young people get it together and do the right thing from day one, because we all know that if the right thing is done from day one, their financial life can completely change. But there are just a lot of people, of course, who don't want us to do it the right way. And we're here, all 3 of us, I think, to protect people from those folks. So it's great to be here and be with the 3 of you.
Yes. And I want to also make mention that Paul's so passionate about his mission that he also set up a foundation, and it's a 50c3 registered entity, and it's the Merriman Financial Education Foundation. And his research, the team, everything is funded through that foundation. And he hosts an incredible podcast called Sound Investing, and I'm a big fan. He also has a YouTube channel now. Not that I don't stalk you guys on the internet too much. Don't worry. Okay, so before we start taking questions, and they're rolling in already off of this thing, I want to reiterate, this is going to be recorded. So please don't worry. If you need to go watch the debate, we'll be here for you. And I will be updating the link at choosefi.com/live so that you'll be able to find it. But I'm going to start off with Paul real quick. Paul, recently on September 23rd or so, you had a presentation for AAII, and you analyzed 11 portfolios, 11 common portfolios that we talk about. I was wondering if you could share some of the findings of the 6 portfolios that you and I identified. The S&P 500, which is a Buffett strategy, right? Oh, and by the way, I'm gonna roll back for a moment. This is an educational and entertainment event only. Please, nothing that is said in this video is to be construed as financial advice. Please work with your fiduciary who knows your specific issues, your specific goals that could give you tailored advice. So, educational and entertainment only. So there we go. So Paul, can you go ahead and talk about the 6 strategies we looked at, and then and tell us what findings you had, and then anything that surprised you?
Well, the purpose of the study was simply to look at a number of small portfolios. I had moved from doing 10 fund portfolios down to 4 and 2, and I wanted to take a look and share with people the range of strategies you could use with what I call no nonsense, easy portfolios, simple to run. And one of them I used was the Buffett strategy. And the Buffett strategy is to put your money into the S&P 500. Now, he also said, put 10% in T-bills. But this study eliminates the fixed income. All I wanted to see was what was the return of the equity portion of the portfolio. I felt that was the only fair way to compare them, because some had a lot of fixed income, some had no fixed income. and you let people develop the fixed income part themselves. So it was the S&P, it was J.L. Collins, one of the heroes of the FIRE movement. His focus is on the total U.S. market. That's one of the 6 we're looking at today. There is the Boglehead strategy. That's the 3-fund strategy. And I actually don't know how many different strategies they have at the Bogleheads. And Rick, you certainly have your hand on that one. And then we looked at what we call the Fama French strategy. It isn't really their strategy, but we combined the total market index with a percentage of small cap value. We used 30%. We also looked at Rick's Core 4. Again, equity only, because Rick has 4 different levels of risk. I took out the bonds. I looked only at the equity portion. And then we looked at our U.S. portfolio, what we call the 4-fund combo. And so what I wanted to know was, how did these different strategies hold up in different during different periods of time? And Meb Faber has a piece that he shows. If you look at a whole bunch of investment kinds of strategies, most all of them end up about the same place. And I was kind of curious how different these returns might be. And what I did was we assumed we put in $10,000 and we looked at the compound rates of return for breaking it into 10-year periods going back to 1990. So a relatively short period of time, and did not include a period that internationals did very well. But we really were relegated to that because we had to cover all of the different assets that were in the study. Mm-hmm. Bottom line, the Buffett strategy was a 10% compound rate of return. The total market index, 10.2. The Bogleheads, 8.8. Now, in the study, we show what kind of money that turns into, but we all know that when you have a higher rate of return, it's going to multiply that money greatly. And the Fama French strategy, 11.4. The Rick's Core 4 was 8.9. And that's because there's international in there. The all U.S. strategy, the 4-fund strategy, was 11.8. And we have it broken down by the year. We have it broken down for risk. And so you can see the good times and the bad times. Here's what I found that was really fascinating. Mm-hmm. Yes, the U.S. only strategy, which had small cap value as part of that portfolio, large cap value as part of the portfolio, U.S. blend, large blend, international, small blend, no international. Yes, it compounded at considerably more than the S&P 500, almost 2%. If you take out 3 years, 2000, 2001, and 2002, mm-hmm. Guess what? The return was the same. I get a lot of questions asking about, how likely is this to happen again? All of it, whether it's the good or the bad times. But there is so much patience. Larry knows this, Rick knows this. The key to success is to build a portfolio that you can be patient enough to wait for the 2000 through 2002 to happen so that you do come out on top. And Jen,
hey, Paul,
you want
just one comment for you, right on line with your last statement. So one of the great anomalies in all of investing, to me, it's the biggest anomaly. If you ask all of the people who are listening to this call, who is the greatest investor of all time, I think the vast majority would say Warren Buffett. But despite the fact that Buffett gives his advice freely, I wrote a book quoting him, dozens of his quotes. They not only, ignore his advice frequently, they tend to do the opposite. And Buffett's statement related to your analysis was this. He said, when it comes to investing, once you have ordinary intelligence, what separates, in effect, the winners from losers is if you have the temperament, and temperament trumps intelligence. You have to have the temperament to endure very long periods of poor performance, because every single asset class, whether it's U.S. large stocks, small value, gold. I mean, gold lost 86% of its real value from 1980 to 23. Yeah. And now it's done great since then, right? But if you bailed out, you don't get those returns. So Buffett himself tells people, temperament trumps intelligence.
Yes.
I'll throw my 2 cents worth in. Okay, so Paul's analysis and what Larry is saying is exactly right. I mean, strategy, meaning how you put your portfolio together, whether you're going to include international or not, or whether you're going to include value or not, or real estate or not, is a very minor thing. It doesn't matter very much. What matters is whatever strategy you decide to use, sticking with that strategy for basically your entire life. That's what matters. Because if you go from one strategy to another strategy to another strategy based on the return of 3 years, 2 years, 5 years, heck, the average time people hold a actively managed portfolio is between 2 to 3 years. Keep moving around from one thing to another, you're never going to do well. It doesn't matter what strategy you have. So what really matters above and beyond what icing you like on your cake is sticking with the cake. That's the bottom line.
Yeah, I just have one comment I'll make. I agree almost with everything Rick said, but I will say this. I would say it just slightly differently. I agree completely. What matters much more than your asset allocation is your ability to stick with whatever it is. But if you concentrate your assets in any one strategy, imagine a Japanese investor who's got a home country bias that many Americans have. Yes. And they only own Japanese large stocks for the last 30 years. They underperformed treasury bills. Their nominal return was zero for 30 years. So there it clearly mattered what you chose. Clearly a diversified strategy would be much better. So I would just modify Rick's. As long as you diversify broadly, that's what's key. Don't have all your eggs in one basket. Rick, I know, recommends international emerging markets. So you're getting more of that diversification.
Yeah, I would.
Here's my question, because I agree with both of you, but what I'm struggling with is I'm trying to give young people, the first-time investor, that piece of information, that portfolio that we could agree would be the best if they would follow it. I mean, that's the problem. We don't want them jumping around. But what is that portfolio that we would recommend that we think they should hold for the rest of
Okay, well, I'll give you my answer, Paul. The answer I tell people is, and I'll bet Rick will agree, it's whatever portfolio you are most likely to stick with. So for some people, the S&P 500 might be the best, and only because they will be having to face long periods where international will underperform. And if they bail out, they're likely to do it at absolutely the wrong time. International dramatically underperformed in the late 90s. And then if you bail out, then international dramatically outperformed for the next 8 years. And for the next 12, it's gone the other way. So as Rick points out, you're always chasing what did well. You buy high, paying high valuations, which virtually guarantees you low returns. And you sell after bad periods, which means you have low valuations and high returns. Only fools would buy high and sell low, but we know that's what many investors do because they're subject to recency bias. Yeah. That's the problem. So I believe, that there is no one right portfolio. You have to learn and understand that all risk assets go through very long periods and diversification is your friend. But if you can't live with this tracking risk, you're better off keeping it real simple, even if it means only the S&P 500, even though I think that's not the right answer. A simple, U.S. total Vanguard U.S. and a total international, that's a great place for any starter investor. And that's all they would need, and go buy some CDs. You don't even need a bond fund. You're better off without the bond fund.
So
I agree.
yeah, as a layperson, I would say that what you're saying is that we are our own worst enemy in terms of our emotional response and our impulses.
Yeah,
so if we can
said it best, Jennifer. I have met the enemy, and he is us.
Yeah.
Okay,
Right.
so we have our recency bias, we chase returns, we do all sorts of stuff. We don't have patience. In fact, Paul, you wrote an article recently about people asking you about when should I give up on small cap value and all this? And you said patience was a big thing. So really, it's a very much a long-term strategy. So find a strategy that works.
I really believe we're dodging the question
Oh.
because people walk into advisors all the time and they tell them, this is what we think you should do. They listen to them. Now, we're not advising one person here, but Larry, I'm sure at some point, and Rick in the same position, probably recommended to your kids, this is what I think you should do if you want to believe what I believe. And I think that that's what a lot of people want to know from us. What is it? We trust you, Larry. We trust you. You can tell us.
Rick, you had a question?
I want to explain the difference between a philosophy of investing and strategy, which is what we're talking about. We're talking about strategy here. Paul is talking about what portfolio. Larry is just saying, what portfolio. Those are strategies, okay? And the right strategy for you, as Larry wisely pointed out, is the one that you can maintain, clearly. But strategy is different than philosophy, okay? The philosophy that we all have, all three of us have, is buy low-cost, broad market type funds, whether you're going to include value or not include value, or include international or not include international, or whatever asset classes you're going to include to have a multi-asset class portfolio. Buy low-cost, broadly diversified, tax-efficient, rebalance once in a while, and hold it. That's the philosophy that we all have. Whether my portfolio, I can guarantee, we all have the same philosophy. I have the same philosophy as Paul and Larry. We all have the same philosophy, but I can guarantee you my portfolio is not the same as Paul's portfolio, and it's not the same as Larry's portfolio, because I have a different life, and I'm different. And so, but my strategy is going to be different, but our philosophies are the same. So individuals, in order to be able to maintain that discipline, in order to be able to hold it year after year after year, need to create and need to find, after they have the philosophy, after they come into the church, if you will, and they get the philosophy, they have to find the right strategy that they can maintain for the long term, and that's the best portfolio for them.
Mm-hmm.
Yeah, let me make a few comments here. One of my favorite expressions is based upon, I think if I've learned one important lesson in 25 years of working with individuals, is the single biggest mistake I think they make is when it comes to judging the performance of risk assets. They think 3 years is a long time, 5 years is very long, and 10 years is an eternity. Any financial economist worth their salt will tell you when it comes to risk assets, 10 years is almost certainly nothing more than noise and needs to be ignored, which is why I do a presentation, which I've done to many different professional advisory groups, the AICPA, NAPFA, and others, which I'd be happy, Jennifer, to come and do for your group, called What Do You Do When a Strategy Performs Poorly? Here's a great example. The S&P 500, a very common portfolio, that's Paul said the Buffett. I think every one of your listeners, literally everyone, will be shocked to learn that it experienced 3 periods of at least 13 years where it underperformed totally riskless treasury bills. Yep. 15 years from 29 to 43, 17 years from 66 to 82, and then more recently 2000 through 12. Now, anyone giving up on stocks because of that is making a simple mistake, because stocks have to have higher expected returns than riskless T-bills, but they also have to have long periods of underperformance, because if they didn't, there would be no risk for a long-term investor, and there should be no other kind. You would just wait it out and you get your reward. But we already explained Japanese investors have gone 30 years with massive risk and zero. That's why diversification, I think, is your friend. Let me just come back to Paul.
Yes.
I train advisors around the country in this BAM community. Hundreds of them I've trained over the years. And when someone asks me, Larry, what should I tell a client? What portfolio should I recommend? I tell them, never recommend a portfolio. Your job is solely to educate the client on the pros and cons, because they are the ones who are going to have to live with the consequences, not you. And if they don't understand those pros and cons, and then play devil's advocate when they say, all right, Larry, you showed me the Monte Carlo results. Here are the odds of success with this strategy, this asset allocation, this withdrawal. I want this. Then I say, make sure you now point out this strategy. Here are the long periods it did poorly. Are you sure you can stick with it? I will never recommend a portfolio to any client. I will only educate them on why I think they should consider a certain strategy, because telling them what to do is absolutely the wrong thing unless they buy into it.
And I want to make sure.
I agree with that.
Yes, I agree with that too, even as a coach. But one of the things I should let you know, Larry, since you may not be familiar with Choose FI and our community, is most of us are DIYers. And I want to actually come back to something that you said. So, and actually I've seen some questions about it. Where do you think the economy is heading now, guys? And I think for me, I would say I have no clue. But when Larry brings up this idea that the Japanese market stayed so suppressed, if you will, for that length of period, I can't help but think about the Japanese government's quantitative easing that was incredibly generous. So we know that our Federal Reserve has also done an incredible amount of, Larry's smiling. I'm afraid that I'm asking a stupid question now.
There are no dumb questions, I tell people. The only dumb question is the one you don't ask.
Yes. So my question is this: how likely is it that our own Federal Reserve's mission to do quantitative easing as generously as it is now likely to lead us down to a path of deflation, something similar to the Japanese economy, where you've just cited that their country bias, if you will, has suppressed their own growth?
Well, I'm a trained economist. I sold economic forecasts for one of the largest financial institutions in the world, advised some of the biggest companies on the outlook for the economy, made forecasts. And here's what I will tell you. When I got a forecast right, I took credit, of course, for my brilliant analysis. And when I got it wrong, I would have blamed it, of course, on some unexpected event, which by definition was unforecastable. So I was either right or unlucky. Of course, when eventually smart people figure out that it was luck when you got it right and maybe bad luck. Of course, some people can't do good analysis anyway. So that's the first thing. The evidence on economic forecasters are there are no good forecasters, period. They don't exist. So you should ignore economic forecast, period, with that. Number two, specifically with Japan. All right, Japan has been engaged in massive fiscal stimulus and unprecedented. They are now have 250% plus debt to GDP, and their economy has had no growth, pretty low for 30 years. The markets had no return, and they've had no inflation despite trying to create it. And one of the reasons is why. What do people like Paul and maybe Rick is getting up there closer to our age and me, but the older people do, or even younger people, when they see government running massive deficits, they say, gee, Social Security won't be able to pay out what they're supposed to. I better increase my savings rate to make up for the fact that I don't know what's going to, I've got to be more reliant on myself. The saving rate goes way up. That pulls bond yields down, and people saving more means the economy slows down. And what's good for one person to do is really bad if everyone does it. So there's a possibility that the Federal Reserve easing, I even debated with one of the head of the Federal Reserve banks at a major conference, and I pointed this problem out. I said, you're creating a recession here. By keeping rates low, every one of my senior citizen clients says, I have to cut spending because my interest income is no longer enough. I've got to cut spending. And he said, Larry, you know, you're right. There's evidence from a UK study that shows this effect is actually happening and slowing the UK. I think that's why the Federal Reserve has actually resisted going negative interest rates, besides wrecking banks who are the key to the economy. If banks can't lend, the economy shuts down. They provide the grease that gets the wheels of the economy going. So I have no clue what will happen. We could end up with high inflation, printing all this money. On the other hand, I think it's equally possible we may end up with deflation. So you have to build a plan that will survive either of those outcomes.
Well, we already have deflation in the EU, we have deflation in Germany, and they have negative interest rates.
Yep.
So it's and Japan is right there with them. So what has to happen with all of the monetary policy decisions that are going on by Chairman Powell is there has to be an equal amount of fiscal policy decisions. In other words, there has to be spending by government, because exactly what Larry said, you just hand out checks to everybody and a lot of senior citizens. I live in an over 55 community, and at the pickleball court, everybody was talking about getting their stimulus check. Well, they don't need a stimulus check, okay? I mean, they're getting Social Security, they're on a pension. They didn't need to get this money. I mean, what did they do with the money, Larry? What did all those seniors do with the money once they got it? What did they do with it?
My guess is they banked it.
That's exactly what they did. They put it in the bank. Every one of them put it in the bank, and all of a sudden you've got M1, M2 going up sky high. Okay, and you have to have, unfortunately, I say this, but you need to have monetary policy as well, which we're fighting over right now. But the government has to go out and start spending money. So you have fiscal policy and monetary policy working hand in hand to try to get the demand going, to get inflation up to that over 2% target that the Federal Reserve is shooting for now. If it's just monetary policy, it isn't going to happen. We're just never going to get there.
If I could
please
address, I think the do-it-yourself investor. My view is, well, in fact, in my new book that's coming out in a couple of months, I talk about $12 million decisions. I think one of those 12 is the decision to be a buy and holder, as opposed to being an active participant in buying and selling after you figure out what to buy and sell. I believe that it truly is $1 million difference over a lifetime. I'm talking about from when you start working until you die. If you decide to be a buy and holder and not, in fact, get into what I actually consider to be a kind of a market timing strategy, that you try to take some piece of information and make a wise decision to get in or out of a particular asset class, stocks or bonds. Those things, I think, drive people to lower returns in the long run than getting the higher return. Timing hurts people. And so when we get into a conversation like this, it's fascinating. But my question is, what does that do-it-yourself investor do? And I think I know what the answer is from you guys. Nothing, correct?
Yep.
I mean, that's
the hard part. Rebalance and tax loss harvest. That's it.
Yep.
I mean,
well, let me add one other thing, Paul. Here's the thing. I urge people, when you start out, you must sit down and write an investment policy statement that puts down on paper, so it will hold yourself accountable. Here is my target. Let's say it's 60% stocks and 40% bonds, and you should put a rebalancing bands around it. Let's just say 5%, just to keep it simple. You don't do anything unless your stocks drop below 55. If they do, you sell some of those safe bonds and you buy stocks. That's hard to do because the market is down and you're worried. But that's what's needed if you want to buy low. And when it goes above 65, you need to sell. That's much easier to do. And there's good behavioral science on it because people feel good they took a profit, right? So it's easier to do. The hard part is buying when the only light at the end of the tunnel looks like the truck coming the other way, as it did on March 23rd or March of, March of 2009, right? Right, and it's tough. But those who rebalanced in March of this year, the U.S. small value stock, the fund I own, is up over 60% since March, right? Now, it's still down quite a bit for the year, but if you rebalance, you're not down anywhere near as much. And the S&P is up like 50% since then. So they're all up, but you only got that if you stayed the course. So the other thing I would tell people is not only should you write that rebalancing plan down to hold yourself accountable, check it. I don't care if you check it monthly, quarterly. I would say no less than annually, though. But you miss big opportunities if you don't do it more often. I would recommend at least just checking quarterly because you can get massive moves and you lose opportunities to buy. Now, sometimes, of course, not buying is good. Like in the 07 through 09 crash, you were better off waiting like a full year. But most of the time, it turns out you're a little bit better off, buying a little more frequently, but not too frequently because there are trends. So I wouldn't rebalance every day or every month. The earliest would be quarterly. Semi-annually is fine. Even annually is okay. The other thing you need to do is you need to look at what happens when life happens. There are deaths, divorces, loss of a job, and inheritance. Those things impact what I call your ability, willingness, and need to take risks. You inherit $1 million. You now no longer need maybe an 8% return to make your goals. Maybe you need 4%. So why are you sitting with 6% or 60% stocks? You can lower it. You lose your job. There's a divorce. You can't take as much risk. You need to adopt your plan. And as we age, typically our ability to take risk goes down because we no longer have labor capital to rely on. So that's an important issue. So investment policy statement has to be a living document, but it should only change when life happens or something happens to cause your ability, willingness, or need to take risks to change.
Absolutely. I wanted to, sorry, Rick, go ahead.
Now, Larry mentioned something, and I want to bring it out
Sure.
because it's important. He mentioned tax loss harvesting, okay? And this is simply when things go down, you sell them and take the tax loss, and you buy something that's similar but not substantially identical. And I don't want to get into the IRS tax code of what substantially identical means because the IRS hasn't even said what's substantially identical. But it's hard.
Yeah, and most of the community is aware of the wash sale rule, so I think we're good.
Let me just finish the thought here. Where people could make a lot of money is not trying to figure out when to get in and get out of the market, or whether or not they should have 18.3% in emerging markets or 18.5%. Okay, that's not. You could make a lot more money if you spent a little time learning about taxes and learning about where all these different levels are as far as the tax rates, and learning how you can use things like backdoor Roth and a mega backdoor Roth and all these other tax savings vehicles. In fact, Buckingham just hired probably one of the best tax advisors out there. Jeff Levine, I interviewed him on the Boglehead show. He's phenomenal. So if you want to follow somebody, follow Jeff Levine. He's great. But think about this. The next time you want to go in and research and spend time trying to figure out the next whiz-bang strategy, don't do it. Pick up a tax book and start reading about taxes. And I think you'll find you'll make a lot more money figuring out the tax code than you will trying to figure out the perfect asset allocation in your portfolio.
Hey, Rick, just one point we can make, a simple one to help everybody on the call on tax loss harvesting. One of the most common mistakes that I see investors make is they wait till the end of the year to harvest losses. For example, if you did that this year, there are no losses in the S&P 500, where if you loss harvested in April or March, you got a big tax deduction, you bought it, you lowered your basis. And also you want to make sure you're harvesting losses when they're short term, because they can be more valuable than when they're long term. So that's why you don't want to wait till the end of the year. You want to make sure. Now, my rule of thumb is you might set a figure like 5%. So make sure the losses are at least 5%. You could pick whatever number you want so it's significant, because it does take some work and you have to reset basis. But whatever it is, don't wait to the end of the year.
I agree. I always ask people, well, maybe I'm dating myself here a little bit, but remember the year of the crash, 1987. The market crashed 30-something% in one day. But what was the rate of return of the S&P 500 in 1987? If you waited to the end of the year, what was the rate of return? It was up 5%. That's right. Thank you, Paul. It was up 5%. So the crash actually didn't happen. If you look at the annual returns, year by year, calendar year returns of the S&P, there was no crash. So exactly to Larry's point, you've got to do tax loss harvesting when you can, opportunistically, rather than waiting till the end of the year.
Yeah, most years, people are surprised to learn this, but most years have losses of at least 10, or drawdowns of at least 10%. So you have plenty of opportunities, especially if you're the typical younger DIY investor who's adding a little bit every month. So you got all these different lots that you can examine, and you want to make sure you're not looking at your average cost, but your cost by lot, and take advantage of those opportunities, especially harvesting losses that are short term.
Yes. I had one last question before I turned it over to the Q&A in the feed that I had sent you guys a little earlier. So, we talk a lot about diversification for the first few minutes of this live stream. And one of the things that sort of worries me is that the FANG stocks are so overweighted in a market cap situation. So as a thought exercise, how would you craft a simple, low-cost index fund strategy to account for FANG and Tesla market capitalization? And would equal weight be a viable solution? Pros, cons? What are your thoughts on that?
Well, I'll go first and say quickly. One of the things you can do is diversify internationally, and then you've automatically diversified out of the FANG stocks. Okay. Plus, you've diversified into industry groups that are not as prevalent in the U.S. market, where we're overweight in technology and communications and healthcare. You don't have that if you allocate money internationally. And as far as equal weighting, that's fine if that's what you want to do, as long as you do it for 25 years. Equal weighting is fine.
I'll give you my quick comments. First of all, Jennifer, it's important to understand that this heavy concentration in the top 5 or 10 stocks is not unusual. It is very common. It has happened many times before. Now, here's what your listeners need to hear. All right. How do stocks get to be the top 5? They get great returns over the last decade. Now, what does that mean? That means their valuations have gone way up because they far outperform what the expectations were 10 years before. Nobody foresaw the kind of earnings and growth that Google, Facebook, nobody saw a pandemic that helped them in these things. That's why their valuations have gone way up. Their PEs have gone way up, partly because they exceeded expectations. Now the question is, you can't buy yesterday's returns. You can only buy tomorrow's returns.
Mm-hmm.
So how do the stocks in the top 10 perform after they get in the top 10? That's what people should think about. I'm willing to bet there's almost nobody on this call who would get it right. But the answer is, over the next 10 years, they underperform by almost 2% a year.
Really?
Yeah.
That is, wow.
And that's to be expected. Now, here's the rationale why everyone should logically expect that to happen. Why do people pay high valuations? Because they think they're great companies. They must be safe investments. How can safe investments have high expected returns? They shouldn't. They should have lower expected returns. It's the price you pay for safety, if you will. Now, that's not a guarantee, and some go on to have even greater performance. Nobody, certainly not Rick, I, or Paul, will know whether Tesla turns out to be the next Microsoft, or maybe it turns out to be the next Xerox or Kodak, which were the Teslas of their day trading. Xerox was trading at over 100 times earnings, I think, at one point, and it went basically bankrupt. Kodak, Polaroid, these were the FANG stocks of their day, and they're all gone, basically. So that's what's important. The way to diversify, number one, as Rick said, that's the simplest. Just diversify internationally. And then another way to do it would be, you could add, say, a small value fund, as Rick did for his clients. Add however much tilt you want, 5%, 10%, whatever's appropriate for you. And that will give you diversification. So when there are periods like this, when large growth outperforms, you can congratulate yourself. You own some of them. And then there were periods like 2000 to 2007 when small value dramatically outperformed. And listen to this. Small value from 66 to 82 beat the S&P 500 by over 1,100%. Nobody knows what'll do well when. So the guiding principle should always be diversification.
And I think I've always taken the position, and in fact, it's gotten me in big trouble in the late 90s, that what we believed in was a balance of big, small, value growth, U.S., international, slice of REITs, a slice of emerging markets, and that we stay the course because these are all asset classes that have been identified as having the potential of having a good long-term return. During that 5-year period that the S&P 500 compounded at over 28%, our compound rate of return for an all-equity portfolio was a little over 11. And it was painful because you have to constantly go sit down with the clients and explain that this, for the long term, this is what makes better sense, at least from what we know about the past. That was followed by the next 10 years. The diversified portfolios that we had built that performed so poorly performed well, and our firm explodes. People think we really know something. We didn't know anything at all. We knew to stay the course according to a lot of academic research. I mean, that's, I think, what Larry has liked about the DFA company. Rick, I think, has been a fan of their work, but doing the right thing for the long term. And it is not easy.
Yeah, Jennifer, here's something I think, since we're here to educate, I want to give people 3 guiding principles, which I think they should all live by. Hopefully, Rick and Paul will agree. First of all, you should base your investment strategy and philosophy on academic evidence, not opinions. And the evidence says that active management is a loser's game. By that, we mean that it's not impossible to win, but today's statistics show that only 2% of active mutual fund managers are generating statistically significant alpha, even before costs, taxes. After taxes, that number is probably 1%. So the guiding principle is you should be a passive investor using either pure index funds or other similar, what I call systematic funds that just invest in their defined universe of stocks. So that's guiding principle 1. The markets are highly efficient. You shouldn't try to outperform them. Guiding principle 2 should follow. If you believe the markets are highly efficient, then you must also believe that all risk assets have to have very similar risk-adjusted returns. That doesn't mean similar returns. We know that junk bonds are riskier than T-bills, so they should have higher returns, but not higher risk-adjusted returns than, say, a safe treasury bond. Emerging markets are riskier than U.S. stocks, so they have to have higher expected returns, but not when we account for risk. Mm-hmm. So if you believe that all risk assets have to have similar risk returns, and you should, because if, let's say, asset A, U.S. stocks, some listeners here think are better investments than emerging markets, say. All right? So, and you got emerging markets here. Money flows, if U.S. stocks are better, what happens? Money flows into U.S. stocks, driving their valuations up. The earnings of the companies don't change. Emerging markets valuations go down because people are selling them to fund this purchase of U.S. stocks. Their earnings of those companies don't go down, so the expected returns have to go up. In the short term, what you get is U.S. stocks going up, emerging market stocks going down, but your expectation has to be now that U.S. stock returns are lower and emerging market are higher until we reach an equilibrium where they all have the same expected returns on a risk-adjusted basis, including risk of illiquidity. So you should believe that. And if you believe that, then it must follow you should broadly diversify. There's no logic to putting your money only in the U.S. because you have a home country bias. There's no logic to overweighting real estate or whatever, unless you have a belief that, okay, I want more emerging markets. I recognize the risk. I'm willing to take it. So instead of 15% of my portfolio, which is about the global market cap, I want 20. And my advice is, if you're going to sin, generally sin a little. So don't own 50%, go from 15 to maybe 20. But if you want to do 50 and you recognize the risk, that's okay. But don't think you're getting a free lunch. You're getting compensation for greater risk. So the guiding principle should always be broad global diversification, of course, as many unique sources of risk as you're comfortable accepting.
Okay, so I completely agree with Larry. The question is, what is a unique source of risk? Okay, this is always the question. There have been volumes of books written about what is a unique source of risk, and it's very difficult. You know, we have equity risk, we have term risk on bonds, we have credit risk, and so forth. And you have to decide how many, once you've isolated these unique sources of risk, you have to decide how many of these you want to put in your portfolio, and if you can actually get access to them at a very low cost in a very efficient way, because a lot of these risks you can't get access to. So I completely agree with everything that Larry said about, use academic base, without a doubt, that eventually everything has the same risk-adjusted return in the long run, and that you need to broadly diversify across your risks to some limited amount based on what you have available to you.
Yeah, Rick, let me just add one thing. To me, what you should invest in are only things or assets or asset classes or factors that you have confidence that you understand what that source of risk is. You understand the risk. So, for example, I'll make a case here. You're worried about climate change, so I don't want to invest in reinsurance. Then don't invest because you're worried about it, and you'll panic and sell when the risk shows up. On the other hand, Warren Buffett, he's writing more reinsurance risks than he ever has because the premiums have gone up after losses. His expected returns are, so he's running to the risk, buying when it turns are higher. You know, but if you're not confident you can stay the course and you work, then don't invest because you'll panic and sell. Paul,
what do you think?
Well, I I look at the returns of asset classes going back to 1928, and I can look at these four major asset classes that are in this combo portfolio, and I see that over the last 90 years or so, that by owning all four of them, you're never number one. By owning all four of them, you're never number four. And as a matter of fact, the one in theory that should be in last place, the lowest provider of returns every year in theory, is going to be, of these four equity portfolios, the S&P 500, because as Larry said, it's less risky. And what do we see? Well, we can see over the last 90 plus years that it spends a lot of time being number one, not being number four. But it's mostly four, and some ones and some twos, etc. And so what I wrestle with and struggle with in this whole question of what we tell young people to do with their money is, I just heard Larry tell me that he believes about things about the S&P 500 that would probably lead to me believing, if I was going to take his advice, that he would want me to not just have the S&P 500. That's one asset class in a way. Large cap blend. It's some value, some growth, but they're big companies. That is one asset class that can get out of shape for long periods of time, as you said, Larry, 3 times 13 years or something. So why wouldn't I conclude that what you would want a young investor to do for the long term, if they trusted that history of 90 years, why wouldn't you want a combination of more?
Well, you could say that, Paul, but my point is, if they can't stomach the tracking variance risk, which just like the S&P underperformed for 13, 15, and 17 years, small value can underperform for 20 years. I'll show you, this tale is really important for your listeners. Back on March of 2000, if you look at the data, small value underperformed, or value underperformed the S&P growth or the S&P for 1, 3, 5, 10, 15, and 20 years. 1 year later, small value outperformed over 1, 3, 5, 10, 15. It can change like that. Nobody knows. But the problem is, I will tell you, Paul, my experience is, especially DIYers who don't have somebody, whether it's an hourly advisor like Rick, who can pick up the phone and call Rick, hey, Rick, I think I'm going to panic. I need you to help me stay the course. Or it's a retainer advisor, whoever you're working with. You need somebody who's going to play Clint Eastwood and point the gun at you and said, make my day. Here's the IPS you said you were going to stick to. And you told me to, hold you to it, right? Most people on their own can't do it because their stomachs take over in bear markets. And Rick, I don't know about you, but I've never met a stomach that makes good decisions.
So you've given up on the idea that we can educate young first-time investors to look at the market No,
I completely agree. That's our job, is to give them the information to help them make that decision. But until they are willing to take the time, get educated, read books like Rick's and mine and yours and Bill Bernstein, those books, get a handle, determine what's comfortable for you. But if you don't put in that time, then I would say you're better off just owning a U.S. total market fund.
A target date fund.
I would say a U.S. total market, not the S&P, is better because you're at least getting exposure to the other 20 to 30% of stocks, which happen to have higher expected returns than the S&P, but are more risky. The smaller stocks have volatility that's about 40% higher. 40% higher, and small value is even more volatile. So that's the problem. but you have to be willing to put in here's the sad commentary. Despite its importance, money, I say, is one of the 3 or 4 most important things in our life. It's not money, of course, itself, but it's what it could do for us. Give us a roof over our heads, food on the table, secure retirement, putting our kids through a good education, whatever is important to you. Beyond your family and your health, and for some people their religion, money's right up there. And yet our education system has totally failed the public. So it's such a pleasure to be on this podcast with people like Rick and Paul, who are devoting themselves totally to investor education to help people. Because I know Rick can tell probably horror stories. At most schools, if you get any education, it's some stockbrokers coming in to teach you to buy stocks.
That's right.
And which is exactly the wrong strategy. They won't teach you modern portfolio theory and and they won't have you read Rick's books or Paul's or mine, because that's the losing strategy for them. So that's the problem. Sad commentary from most Americans. They'd rather spend time watching some reality TV show, not that there's anything wrong with that, than spending 4 or 5 hours with Rick or yours or my books and get an education. And which is more valuable?
Let me,
it's pretty simple.
I just want to make a comment. Paul, you're not wrong. I mean, you are definitely not wrong. You have the technical side down pat, okay? I mean, technically, you're absolutely right. But the other side of the coin is emotional. It's if you can't do that, if you can't stay the course, then you're going to end up with a lower rate of return. So if a client doesn't buy into or is not completely convinced of the small value premium or other premiums that historically have been out there in the market, if they're not 100% convinced of that and they're going to capitulate like right now after this has underperformed for so many years, we have done a disservice by putting them in it back 10 years ago. They would be better off just having a very simple total stock market portfolio, a few CDs, and go home. And if they can stay the course with that, that's better for them.
Let me ask one more question, then I'll shut up, okay? Because I trust you guys so much, and I mean this, because what you have said would lead me then to believe that it isn't the total market index that they should own, but what they should own is a target date fund. Because a target date fund takes care of the other part. They get the total market index. They get somebody to be there to move them to fixed income as they age, because they're not able to make that decision any better in theory than the decision to have all large cap blend or have some other stuff in there. Why wouldn't a target date fund?
Yeah, I'll tackle that. I'll tell you why I think there are pros and cons of target date funds. But let me point out, at Buckingham, I think we do as good a job as anybody in the world of educating clients. I put out more material than I think anybody. I've written over 4,000 pieces in 25 years about the kinds of subjects we're talking about, including the fact that all these risk assets go through very long periods of underperformance, and you have to be able to stay the course. But when you get periods like we've had since 2017. Let me give you the data. The worst drawdowns for value are about 35%. Now, drawdown doesn't mean negative returns. It could be that growth is up 80% and value is up 50, so that's a drawdown of 30. Or it could be growth is down 20 and value is down 50. That's also a drawdown of 30. Either way, it's underperformance. The worst drawdowns occurred twice in the 30s, when you would expect, when the real risk economically of value, especially small value, would show up. The others occurred, of course, in the late 90s. This one was 50%, much worse than anyone had experienced. So someone could say, yeah, Larry, it's okay, I can live with that. But when it actually happens, my line is this: living through bad times is infinitely more difficult than observing them in back tests. Your stomach doesn't feel the acid it does when it's actually happening. That's why Rick and Warren Buffett are so right. It's all about temperament. So we spend more time, and our average client turnover historically has been roughly 1 or 2%, and that includes divorces, deaths. We've had an increase, not huge, but an increase in turnover because some clients have seen this, and it's only 4 years. And I explained the S&P's had 13 years of much worse performance, 1,100% underperformance to small value. And yet some people panic. So that's why Rick is 100% right. You have to, the behavioral side is going to trump the intellect side for most clients, especially those who work on their own, but even with advisors. It's not that advisors may not be doing their job, although Rick and I have both seen advisors who don't take the time to point out these issues and just put them in some canned portfolio. But even if you have an advisor, they may have lied to themselves, if you will. They overestimated their ability to deal with these issues, which is an all too human trait called overconfidence. 90% of people, no matter what the question you ask them, say they're better than average at something. It doesn't matter whether you ask them if they're better stock pickers or better lovers. It makes no difference.